Okay, let's get the webinar started. Hi, everybody. Welcome to today's IUL and Taxes presentation. My name is Maureen Walker. I am a member of DMI's marketing team. Excited to be here today. For those of you that don't know, DMI is an insurance and annuity wholesaler in Hingham, Massachusetts. We are just south of Boston. We've been in business since about 1989, I believe. And today we welcome Steve Poppy with Annexus today. Steve leads the life unit over at Annexus and brings over 30-ish years of experience to the table. We're also joined with Keith Chatino, who is DMI's Vice President of Life Sales. Keith has experience not only as Vice President of a wholesaling life division, but he is an agent and has the ability to really put himself in an agent's shoes, which is really great when he's working with you to try to, get the best fit for your clients. Answering questions with me today is DMI's BDR, Declan Donahue. So please feel free to ask questions as we go. Be patient with us. Declan and I will get to them. If there's something that we can't answer, we'll probably hold off to the end, and then we will ask, Steve and Keith the questions all at the end. So bear with us, but please feel free to ask with your Q&A. And then at this point, Steve, I am going to throw it all to you.
Well, thank you very much, Maureen. Thank you, everybody, for joining, and good morning, good afternoon to everybody. It might be afternoon where you are. It's morning here. We're in Scottsdale, Arizona. So thank you. Thank you for taking the time to join us today. And we know you're busy, so we really appreciate that. It's tax season. We thought this would be a good time to maybe talk about a few strategies here. It's a good time to, have these type of discussions around taxes with your client. As Maureen and I and Keith and Declan planned, we thought this was a good time of year to really speak to the whole idea of taxes. Everybody hates them. Everybody's looking for ways to defer them or do something to help them, to mitigate that pain. So today we're going to discuss the advantages and the benefits of using IUL as a financial tool. But before we start, I thought maybe we'd take a little bit of time to maybe discuss the Nexus and who we are. First and foremost, the Nexus is a leading independent product design and distribution company in America. Nexus designs solutions to help Americans grow and protect their retirement savings. And since really 2006, I can't believe it's been that long, and Nexus has developed the industry's best performing fixed index annuities and also fixed index life, IUL. So we're going to talk a lot about IUL today. When you talk about a nexus means bringing together or joining together. And there are really three things that bring this together. First and foremost, as I mentioned, we're a product innovator. We innovate the product in-house here. Number two, we distribute our product through a very, very limited elite distribution. So we work with DMI and Keith and his team there. They've been fantastic partners of ours. Keith knows the Nexus better than I do, for sure. He's an expert on our products. And DMI has been a fantastic relationship with us. So you're very lucky to be working with DMI and Maureen and Declan. Fantastic organization, a long track record with us. And that means that you have access to our products that very, very few advisors around the country have access to. So we only work with the best of the best advisors and the best distribution partners. So number two, that's part of our what it means bringing together. And then lastly, it comes down to these these strategic partnerships at Annexus. One thing we're going to talk a little bit about today is maybe kind of give you a little bit of concept here. Sometimes people have a hard time understanding who Annexus is, but we're similar, maybe a little bit of similar way of thinking of us. We're not the insurance company. We partner with the insurance company. And of course, we're not the distribution company. That's DMI. But what we do is we're the developer of the product. So just like Shelby takes the Ford Mustang and strips it down to its chassis and changes it inside and out to make it the iconic race car it is, the famous car it is today. It's very similar to what we do here at Nexus to kind of give you some texture. So we take the IUL, we don't need to reinvent the IUL, that's been invented, but what we do is we strip it down to its chassis, and then we apply all the innovation we've learned through our research. So that gives you kind of an idea of what we do here at Nexus. Hopefully that makes sense to y'all. And then, how do we do it? Well, as a matter of fact, we work with a actuarial firm named Genesis Financial. And our team of product developers in Genesis Financial, that's where we get this R&D, this innovation around these products. We have 17 actuaries working on just a handful of products. So that's where we get this capacity to do this product innovation. You can see on the screen there, we have 37 patents either issued or pending. You and I know those don't come easy. Those aren't cheap. So that should give you some idea of, of who we are. It's these 17 actuaries and just only a few products. And then lastly, yes,
Stephen,
go ahead.
sorry, I'd like to interject. Just so,
yes, please.
With DMI having distribution relationships with a lot of different carrier products in the IUL space, my personal experience having worked with all of them on different levels, and there's times where we utilize carriers for maybe an underwriting perspective combined on an IUL chassis, or it's been a revelation having the Nexus partnership in the IUL space. And it really stems from the fact of having products that are extremely consumer focused, but also that perform. We're seeing a tremendous balance between cost associated in the contracts and performance based on the unique indexing relationships that you have created on the Nexus side, these partnerships, the intellectual property that you have combined with, some team members like Tom Haynes and your relationship to the New York Stock Exchange, and that investment side of the indexing portion of the portfolio. I haven't had a product set where I am completely 100% comfortable with the performance of what I'm seeing, especially now with restrictive illustration rates. And we'll get into this a little later in the presentation. But with the regulation and changes as far as restrictions on max illustration rates, and some companies showing a bonus or not showing a bonus and kind of tweaking their illustrations to favor them, the core of this is the underlying index is actually performing. And I haven't had a product set where I know from day one, when I get this policy issued, if the advisor I'm working with only keeps that original illustration at whatever the max illustration rate was, I have advisors not even necessarily getting in-force illustrations anymore. They're just looking at the current balances as far as the accumulation, and they're all ahead of the game through a wide range of times. So there's extreme comfort for the consumer and the advisor, not having to have calls from clients saying what transpired here, what happened here. So it's been a really kind of groundbreaking relationship as far as the IUL space from a DMI perspective and our advisors that are working with us with these products.
Yeah, well, thank you, Keith. We appreciate that. We really really love the relationship with you guys. So, what Keith said is very true. At Nexus, it really begins with the mantra of, we want to be first, we want to be the best, or we want to change the game. And the only goal we have here is designing products that provide better client outcomes. We want your clients to win, and Keith just said that. We want to put you in a position where you never have to apologize for selling something of a Nexus. So that's a really strong, so today we're going to look at, these are some categories. We thought we'd put this up here on taxes. How are assets taxed? Of course, there's taxable assets. Investments are generally taxed at income tax, capital gains, or dividend tax rate. Exemplar stocks and most bonds, some of your Social Security, CDs. Then, of course, you have tax deferred. IUL plays in the tax deferred space, annuities, 401ks, pension, things of that nature. And then, of course, the category there at the end we're talking about today is assets grow tax deferred, and the money can be withdrawn out of the IUL on a tax-free or tax preferred basis. So those are the areas of taxation that you can look at. And then why use IUL? Well, here's the benefits. You know, this is not a death benefit product. This product is meant to help your clients save money, to accumulate money, and then it's built to help you create income for your clients. But you know, life insurance, IUL has special tax treatment and special benefits that no other product offers. You know, a tax-free death benefit, yes, it has that. That's not the main reason you use IUL, but it's an important part. The tax-deferred growth, right? Tax-free income, it's flexible. You got a lot of businesses out there right now that are doing extremely well. They have employees they're worried about leaving. It could be a great tool to retain your top talent. There's no required minimum distribution. You hear a lot of complaining from your clients when they get that age, they got to pull their money out. You don't have that. So just access to capital. Those are just flexibility. Those are just some of the reasons that people are using IUL as a financial tool. And you know, these are the layers of taxation you have to consider when you're working with your clients, right? And this is also a marketing piece. One thing about Annexus is our innovations around the product, but our innovations also around the marketing. So our marketing team here in-house builds all these products and the marketing collateral together. So they're going to tell a cohesive story in the field for you. And I'm going to show you where you're going to get that here in a minute. You get that in My Annexus with Keith. Keith can help set that up for you. But these are the layers of taxation that you should concern yourself with and talk to your clients about.
It's often overlooked. If Steve, you can go back to that last slide real quick.
Sure.
You know, factoring into someone's retirement distribution plan, you know, obviously starting an IUL for a younger client is ideal, but we also see it for older clients as well. Just from the sheer fact of being able to manage their tax bracket and being able to pull distributions out of an IUL where a security product may had a down year and you don't want to draw from a negative performance year, and it doesn't factor into your tax bracket. And there's no reduction in the Social Security benefits. So if you really have someone that's interested in the tax conversation, and they're constantly talking to you as their advisor about how do I reduce taxes or address taxes, utilizing Index Universal Life is something that kind of, there's never too late in a lot of instances to get started, depending on, you know, the older they are, depends on how much money they have available to put towards it and their time horizon. But definitely the 8-layer protection piece, I love talking to that 55 and younger and generating those opportunities with that age group.
Yeah. Thank you, Keith. That's a great piece. And then also here's this, you know, just kind of give you some idea. I mean, we have a lot of great marketing to help you. This can benefit you when you're working with your clients. These are pieces you got the QR code, you can take a picture that you want. All these and more are available on My Annexus. So I have found when I was in the field myself, and I have found with a lot of people I work with, these are the reasons people are looking and utilizing IUL. It's around the benefits of taxes, the pain of taxes. So let's get into this a little bit here. Why Annexus IUL? First one we're going to look at is we're going to look at the New Heights IUL. We make 2 different products, one with Nationwide, one with Securian. So what we have found here, if you're going to use this strategy that we've been talking about, you know, as a tax tool, you know, you're looking for special features or special design around the product. And what we say here at Annexus, we're not an illustration company. What we are is we're a product developer. We're a design company. And the probability of this working out for your clients, the sustainability of the policy, and being a viable financial tool for your client does not come down to the illustration. Just like when I showed you that car before, like Keith mentioned a minute ago, that car had a paint job. And a lot of times that illustration is it's just makeup. It's just eye candy. It's a marketing tool. But what's behind the product and how it's designed is really going to affect the outcome of your client's success. In our research, all the people we work with, I told you 17 actuaries, Keith mentioned all our strategic partners, tell us there's really 3 key components for these IULs to work out. And first and foremost, nothing's going to matter more than cost. It really, really matters a lot. What you got here with both these products, one of the 3 lowest cost products in the industry. Now, you may think to yourself, cost, what do you mean? Well, I'm not talking about cost of insurance. That's pretty minor in these, pretty minuscule in these products. What I'm talking about is just the net aggregate cost over a large number of years, 20, 30, 40 years. Those are really, really, really important to know. Now with a Nexus, and when you're working with Keith, when you get an illustration from a Nexus, it always has an annual expense report on it. And we feel like that's a really great place to start. If you're going to do any kind of measuring or comparing, we feel like that's the place to start. Look at the total expenses. That's a great indicator of the design of the product. The second thing you're looking for here in the box is these high par rates. Our par rates on the New Heights product just went up recently. I think that really speaks to our design, the sustainability of our product. We feel very comfortable that these par rates will continue for a long period of time. But you can see you got really strong par rates. Why do the par rates matter? Well, the par rates matter because it's just easier for your clients to get that return. It makes it easier for your clients to put more money in their pocket. You don't have to have some 5, 6, 7, 8% linear return for your clients to win, right? You also see in the box one of our methodologies and one of our guarantees is our indexes are uncapped. He spoke to those a minute ago. That's a very great, that's a nice feature to have now. And then lastly, we also build, besides in the design of the IUL, we also build the indexes. They're proprietary. Those are our Nexus indexes. So, and then the third thing you're looking for that really gets underappreciated or missed is what are the guarantees on those par rates? What can change contractually to embarrass you that they're not working out? What is the lever a carrier can pull to change the deal? So that is the three things we have found through our research matter most: low cost design, good strong par rates, and knowing what the guarantee on the par rates. And then if you go on, so that's the New Heights product nationwide.
Hold
And
on,
then,
Stephen, for
yep, go
just to
for
go
it.
back to that. So
Go for it.
what, the evolution of the IUL space, everyone knows that Index Universal Life has their 1-year S&P 500. Generally for decades, it was a capped option where there was a certain cap on what you can earn. And it's evolved. And Nexus has really been at the forefront of bringing these more intuitive, more actively managed indexes, more diversification indexes using uncapped methodologies and moved away from the cap solutions. Yeah, anyone who's in the IUL space now sees those companies plopping in those indexes on every product they have now. The cost of the options and the expense internally for that are less expensive. You can give higher participation rates. You can do, caps have gone down over the years. Saw a slight uptick in caps by, basis points recently, but every carrier out there is now honing in on their uncapped, low volatility index. The big difference is what Stephen talked about before is the 12, 13 actuaries on staff, how they build those indexes, the actual performance, not being a back tested product where we're looking at what it did in the past. How is it going to do in the future? It's just superior. The performance has been superior over time. They've proven it on the annuity side of things, and they're doing it on the life insurance side of things. Because there's been indexes that have been touted where that I've personally have, reviewed and looked at where, yeah, it looks great. Look what it's done in the past. And the first 2 years that it went in there had 0 returns. So you have to have that strength behind and understanding of what's going in behind the scenes. And they've proven it over time. And the other thing is the strong guarantee rates, in particular with the nationwide New Heights product. To be able to have an Index Universal Life product where the participation will never be below 100% is incredible. You combine that with Nationwide, the brand and the company itself, because I guarantee you, if you look on your book of business and you go into the portfolio renewal rates on IUL plans, you're seeing companies creep those participation rates down to the minimums. It had to happen. That was a lever that needed to be pulled by the carriers. And, some carriers out there have a 30%. You're at 125 today, but they can go all the way down to 30. Some are at 45, some are at 60. Nationwide with theirs to be at 100% is just another foundation of stability that they bring to the table. And, you know, that's a pretty incredible story in the marketplace to be able to bring to a client.
Yeah. Well said, Keith. And also just kind of keep going what you said, what you do find in the marketplace is, we designed our product around the low cost chassis, the low volatility indexes. So it's built on that. So that's what reduces the cost. And what you're seeing is, the industry is starting to see that the value of these low cost indexes, like Keith said, but what they're doing is they're just retrofitting those indexes on their higher volatility S&P chassis. So it's still an S&P chassis, put in low volatility indexes. We have built the product with the low volatility indexes in mind. So that's a big differentiator. Also, a good point Keith made. I want you guys to understand what we're trying to do here at Nexus. The product is made to meet or exceed illustrated rate. That's the whole design of the product. Yes, it's uncapped. You're going to have some big years, but as a matter of fact, there's a 93% chance that the indexes will meet or exceed illustrated rate. So that's why these par rates help that. It's not that, it's not about the indexes per se. They're just a part of the design of the product. The part of the product that matters is going to be this low cost structure. It's going to be the uncapped. It's going to be the par rates. It's going to be the guarantees. The indexes are going to do what the indexes do, but they just make it a lot easier for your client to meet the illustrated rate. And you and I know, when you go back to see your client and you're meeting that illustrated rate or exceeding it, that's a good story. That's a happy story. So that's the position we're trying to design around that. And then, of course, we also make with Minnesota Life, Securian, Minnesota Life. Sometimes I just call it Minnesota Life. People seem they know that more. But the same way, Keith knows his product. He's been on it way longer than I have. It's been this is our first product. Balanced Growth Accumulator 2, again, the same thing, very low cost design. As Keith mentioned, Nationwide, Minnesota Life, mutual company. We partner with mutual companies for a reason. The track record, taking care of the policyholder, whether you've been with them for 10 weeks or 10 years, they treat everybody the same. Minnesota Life, as a matter of fact, is the strongest company, has the highest ratings of any company selling IUL. Comdex is 96. So these are great organizations we've partnered with for a reason. And you got the same situation. You got these really low cost. You got these uncapped par rates, 125 to 190. And then again, you have the strong guarantees. So those are the two products you can use.
Steve,
And then,
question,
yep, please,
if I can
please.
interrupt. So I
Yes.
think there's a bit of confusion
Okay.
between a Nexus and Nationwide and who does the designing. So who actually provides the IUL design for Nationwide New Heights?
We do. It's our product.
It's a Nexus.
Yeah. So they're paying the claim. It's on their, they're the company on it. But yeah. So they're the carrier, but we're the designer of the product. They're our partner. They're our partner in the product.
Right. Right. So hopefully that answers that question. And then there was a question about the IMOs. As far as I remember, DMI has sort of been, since Nationwide New Heights came out, DMI has been one of the partners with the Nexus, hasn't it?
Yeah, there's only 23 of them, and DMI is one of the original. They've been with us since day one.
Yeah.
Yeah.
So Terry, I'm not sure what the other IMOs you're thinking of, but DMI's been on that list for pretty much ever.
Yes. Yeah. And we say a lot of times it's about the partnership with you all. It's about the partnership with DMI. It's about our partnerships. We know we have a responsibility to make a great product. We work really hard at it. We put our hands to our heart every day and saying, hey, we want your clients to succeed. But there's more to this than that. And it's all about these partnerships. They're very important to our strategy.
And then one more question, which I think is a really interesting one. So does a Nexus come up with the idea of a product and then pitch it to carriers? Or do you guys actually work with carriers to come up with ideas sort of together? Or does it a little bit of both?
First way, we make it.
You guys come up with
we make it, and then we shop them to find where it fit. We're looking for certain criteria. When we did this, we did a lot of due diligence, what we are looking for, finding the right partner. We also have a lot of people, we are probably the biggest little company you haven't heard of. I mean, Wall Street knows the Nexus. So we have a lot of people knocking on our door wanting us to design a product for them. But it has to fit our model of what we're trying to accomplish.
Excellent.
Make sense?
Yeah, thank you.
Okay. Yep, you're welcome. Thanks. Great question, you guys. So this is
Sorry,
probably,
Stephen,
yep,
sorry, wait, a
mhm,
couple more things, right? So the
yep,
zebra index, there was a question, is the zebra index an Nexus index? So,
yes,
I mean, it was built in collaboration with Ibbotson, and it is an Nexus only index of as far as available on a Nexus products. So it's
yeah,
on the nationwide New Heights IUL. It's on
right,
their annuity product. So that is the partnership that Nexus has with Wall Street and intellectual property in that regard. So you won't see duplication of their indexes on another company's product.
okay,
And there's other thing too, as far as product design and development. Yeah, there's companies out there have a core product that they use for their IUL, and that's where Stephen was mentioning that, well, Nexus has their buildup of how the product should look and feel, and the certain benefits, internal workings, and other things, and they try and see if there's a mesh, if there's a marrying that you can make a collaboration on, and put forth an Nexus version of an IUL there.
yeah,
As far as participation rates, someone asked, that participation rate is based on what does the underlying index do over its segment period. There's a base percentage. It may get 5%, but then you add in the participation rate on top of that.
yeah,
So the minimums with Nationwide and New Heights being at 100%, that means that the insurance company, in talks with a Nexus, right? This is a joint collaboration. There's no par rates that are moved without a Nexus being involved in talking about it. So a benefit to that is you will see changes in the Nexus indexes at a much slower rate in the negative compared to other companies and how quickly they move off of their rates. And Nexus is holding the highest participation rates for as long as they possibly can, based on all the things that they know about their product and the behind the scenes. So there's times that they've held their participation rates for 5-6 more months than someone else, where you see cap changes. Some companies have cap changes on their 1-year S&P 2 or 3 times a year. So that's another value add and benefit to the consumer, benefit to the advisor, and benefit to me as a wholesaler of these products, that I know they're going to hold on for as long as possible. And they, on the flip side, they're the first to really bounce back. Like, they want to be able to bounce back. They had a change on the Securian product where their S&P Prism index dropped 5%. It went, one of them went from 195 to 190, and their 1-year S&P Prism went from 125 to 120, and they held that for only like 3 months. And as soon as they could, they went back and they added that 5% back. So they're looking at it, definitely in the favorable light for the consumer, and that's actually something that has been very eye-opening as
yep.
well, since I've been working with them on their products.
Yeah, thank you. And we're going to hit that here in a second. I pulled a slide. And remember, you guys, we can do more of this one-on-one. I mean, we could take a deeper dive into, this is, we're not going to go through a lot of the stuff. It's more around the taxation. But, Keith and I can get on the phone with you all, any of you, if you want one-on-one. We can go more through the indexes. We can go more through the design. We can take a deeper dive into these, no problem at all. That I'm love that. We can talk about cases, whatever you want to do. I mean, loop me in. I mean, Keith's the man. He knows how to do it too. He's awesome. And also just think about this way, maybe just kind of continue. The carriers have, 30, 35 products, life products, and they have somewhere between 7 and 10 actuaries. Just like Ford Motor Company, they're not in the business of innovating a car. They're a mass producer of vehicles. Just like Nationwide or the carriers, they're mass producers of product. We are a product design company, so we have the actuaries where they have 30 products and 10 actuaries. We have a few products and 17 actuaries. That's why we can do all the design. We're built to do all this innovation design. That's where the 21st century has been a good change, is these IULs are not stuck in time, right? These are innovative products for the 21st century. These products are specifically built to accumulate money and to bring it out for income. It's specifically designed for that. And that's what the innovation is around. You know, like Keith mentioned, we started off as an FIA company. We have all this research. We looked at the marketplace in IUL. We just didn't see the consumer value. We feel like, you know, we're trying to create income for these clients, for Americans' retirement income. We looked at the IUL as an opportunity to, you know, that's a unique product that has a lot of benefits that you can create something around that for your client. We looked at the marketplace. We didn't see what we liked, so we built it ourselves. So that's the evolution of these products. They're different. Now, this slide really speaks to what the question was. A good question asked. This should give you a lot of confidence. This is also, we call this a hurdle slide. I call this a low hurdle. And I call this a hurdle that even your grandchild or your child or even Steve can jump over this hurdle, right? So what we're trying to say here, and this is a marketing piece also on my Nexus, what we're trying to say here is on the far right, that's the raw return needed. Right, we're talking about Zebra right now. This is the raw return needed to meet that illustrated rate, depending on how you allocate your client's policy. And you can mix and match these any way you want. So here talks about the 2-year, 1-year opportunities, which we'll go over more another time. These are the par rates in these areas. The 2-year has a 245 par rate. The 1-year has a 180, and we also have one with a 1% fee at 220. Right? This is the max illustrated rate you can show your client. But what we're trying to say here is all the Zebra needs to do every year, depending how you allocate, is a low number. Look how low that is. Now, compare that to the track record. There's the 10-year track record. Remember, these are uncapped. Right? There's an upside to these too. We're going to have these big years as well. They're uncapped. That's part of this overall. But what we're trying to put you in a position where you don't have to, you can under promise and over deliver. Makes sense? That's the low hurdle right there. We're not saying when you're showing 6.8, we're not giving you some 6% illustrated or 7% or 8% linear return that your clients have to, you know, that's going to set your clients up for failure. This is designed to make sure your clients are hitting those things that are important to them. And then, of course, we also have one that was domestic. You know, we believe in diversification. We teamed up against strategic partners we talked about, you know, teamed up with JP Morgan. We have an index called Mosaic 2. Maybe some of you are familiar with it. That just gives you a chance to diversify that policy international. You know, Wall Street thinks international is going to be better going forward the next 10 years or so. You know, it helps fight inflation. You know, does a lot of great things. Anti-correlates the policy. So there's your choices there. Look at the par rates. Again, right? Low cost, high par, strong guarantees. Well, here's your high par rates. 275.
So
Right.
Stephen, these slides right here really go to kind of the changes that are happening in the IUL space. We've gotten into and we've gotten, everyone's done it. You know, we've had illustrations that at one point or another, if you had a cap that was at 12.5 or 13 or 14, you were showing 7 or 8% returns. Regulations have changed what we can do in that regard. And I feel it's been for the better because it actually makes us focus more on the tax benefits of life insurance and IUL and how to utilize the product in that regard, not because the illustration looks great, right? Look at these numbers. It looks fantastic. I can count 3, 4, 5 companies that we represent, and they're in the navigating through the regulations of what can be illustrated, and they're showing bonuses on their illustration. So you may be illustrating a 6% return, but if there's a 1.65% bonus on there, you're showing your client 7.65 static, hitting that every single year. It's just not realistic. You're, in my opinion, utilizing the illustration to make the case look good, where I would like to fall back on all the merits of life insurance, all the future tax benefits, all the unique riders as far as long-term care or chronic and critical illness protection that you can add on to the plan. So we've taken this back a little bit. Let's provide something that we know that we're showing today that has a high probability of success.
Yep.
And we're doing that by showing these hurdle rates. When a client sees the index only needs to do 2.21%, and I'm going to hit this 6.08. I like these numbers that I see on this illustration. I like the tax benefits you explained to me better. I like the ability of how these loans work and the leverage associated with it. And then you go into the history of the indexes and actually show performance in varying years of what the index does. So I think in a way, the regulation, it's going to change again, right? It's regulation for you that may or may not know. There's going to be some adaptations to the illustration game, and companies that have been illustrating bonuses kind of navigated through the original version of the regulation rules. Going to have to make some changes to their products. And that's another benefit of the, nationwide new heights, for instance. It's set, it's ready to go. There doesn't need to be a change because they're not using bonuses to enhance their illustration. So I love the hurdle rate conversation with advisors and clients.
Yeah, it's a great one. Thank you, Keith. And by the way, this product is 49A compliant. We're one of the first out there, so we feel really good about that. And Keith, you really hit one of my favorite topics, and I'm glad you brought it up. We talk all the time here. It's not about the illustration, right? Our illustrations are as wrong as everybody's. They're wrong the minute they're printed. But what's right is the design, right? And what you should think about is not the illustration, but what problem does it solve for the client? Does this solve a client's problem? Right? Does it solve that? That's what we're trying to do, right? It's not about that. It's about helping the client solve that problem. And the way you solve that problem, or the way of getting there, the probability and the sustainability of the product is going to come back to the cost, the pars, and the guarantees. That's what it's going to come back to, right? So we just really suggest, just don't fall in love with those numbers on the sheet. They may be wrong. They are wrong. They're uncapped. I mean, I can't illustrate uncapped. So I could be wrong on the upside. I could be wrong on the downside. But what I'm right about is a tax deferred vehicle and a tax-free vehicle. I'm right about that. And I'm right about the way of getting to that journey, getting that journey completed for your client is going to be around the resistance being less cost, better pars, higher pars, and stronger guarantees. That will help solve the client's problem, what they're trying to solve. And that's what this is trying to say to you. We're just trying to make it easier. Now, another thing that's really important that we talked about, that third piece, is about, contractual guarantees. Keith mentioned a couple competitors, and there's nothing wrong with these contracts. The par rates are fine. They're excellent. And we're not suggesting here on the right that anybody is going to do this kind of stuff here. This is pretty extreme. But this is something I would suggest you probably want to know before you sell a product. These are the only things you can control in selling IUL: cost, par rates, and par rate guarantees. That's how we stack up. There's our par rates. There's our guarantee. Like Keith said, you're guaranteed to get at least 100% participation rate on the 1 year. Fantastic story there. So, and then of course, actually, I just had this done yesterday, kind of little fun fact, but we changed the par rate. So this is another piece that's on Maya Nexus. Guarantees do matter. This has become, we redid this a couple of months ago. We put this out, been a really, really popular with advisors. This really does a great job of telling our story. And then, lastly, just to wrap up, and we'll take some questions, but it's all about partnerships. I mean, we're so proud and so thankful. I'm thankful I'm working with Keith and Maureen. Declan, it's been great. DMI is fantastic. I mean, they know these products better than I do by far. Keith has been a leader with us for a long, long time. He's a great person to work with. If you're trying to employ these strategies, listen, you're lucky to have Keith working with you, because he can help design. DMI is the place to go for sure. You guys are lucky to have that relationship, and we're very lucky to be working with Keith and DMI and the whole team there. It's just been really, really wonderful. I wish I had more words to tell you how happy we are and great the partnership has been. And then again, I know you guys' time is valuable. I hope I added a little bit of value today. And just, thank you for your time. So let's see if you have any questions. And of course, as I mentioned, I'm happy to do one-on-ones with you, bring Keith in or whatever, he can do it. And we can take a deeper dive into maybe some more deep questions you may have around the products.
Thank you, Steve. That was fantastic.
Thank you.
I also want to mention that a lot of those flyers we have on DMI University. So that's dmiuniversity.com. That will also house the webinar. Once we get this settled, we'll put that up on DMI University as well. But we do have a couple of questions. What is 49A?
Keith, want to take that?
Sure, this is referring back to, the insurance NAIC regulations about what companies can or cannot do as far as what they put forth on their illustrations. It's really obviously focused on providing, consumer advocacy and making sure that they're not being misled in a variety of different ways. So there's been one version of this that was generated by, one company in particular, and I won't say their name, we can talk offline, but they were adding in some mechanisms to their illustration that were showing inflated cash value numbers over time. They didn't really have a good explanation as to how they were doing it. It was a way around the illustration regulation to some degree, and it led to some regulation, which is great. Then companies, like anything else, we want to get an edge. They looked at, okay, well, here's the regulation. We can do this with our product and we'll have this bonus added and then we'll keep it outside of this account. And so then we still have some companies out there where they're showing bonus rates of return on their illustration. And what all that means is, a bonus in many instances is guaranteed, but usually it's only a small percentage that's guaranteed. You might have a 15% bonus guaranteed, or, there's also other things called multipliers that were added where they're giving you a multiplier of whatever the performance of the index did. And those weren't always guaranteed. But these bonuses, when you're running an illustration, again, like I mentioned before, and there's a 6% illustration rate on that index that you're showing on the illustration. If it has a 1% bonus internally, you're actually showing a 7% rate of return on that cash value. Very simple way to understand kind of where carriers want you to go with their indexes is pull up any of their software and you'll see what the default index is that allocation goes to at 100%. It's usually an index that may have had a multiplier in years past, or now is an index that has a bonus added to it. And I've talked to many advisors that are selling some of these products and they had no idea. No one ever told them. One in particular, a product that we do use, I don't ever illustrate 100% in this index, and I actually reduce the illustration rates when I run it. But it's showing about a 6 points, a little over 6% rate of return on the illustration rate. But if you look within the illustration, in years 1 through 10, they're actually showing an additional 1.65 bonus. And in years 2 through 10, they're actually showing an additional 2.65 bonus. So you're actually showing your client almost a 9% rate of return over the life of the contract once you get past year 11. It's just not, it's not good for the consumer. It's not good for the advisor. It's not a great expectation to handle. So I manipulate that backwards. I don't put all the money in that index because I want to see how the policy performs based on all the things that Stephen mentioned. Like, what is the cost structure internally? How is the underlying index actually performing? Not what we can illustrate with a bonus. So, there's another change coming up. May 1st, we're going to see products have to make some changes, and that bonus structure is going to change again. So. Yep. So that's the bonus. That's AG, that's 49A coming out again. Someone else asked, for these products, is there a need to call the sales desk at either the carrier? No, you can call me, right? Really, that's what I would be there to help you with. Whether you want to be trained up on running those illustrations yourself, I can walk you through that. But I would work with you on that. And I would welcome that's kind of your first interaction, because I'd like to be involved and talk to you about it. As far as being utilized in corporate life insurance sales, we use this in executive bonus, and and it could be used in split dollar, it could be used in a variety of different ways. So yeah, definitely, it's not only a personal lines, personal use product, it's definitely used by business owners. And one other question was, do carriers like Allianz come out with their current 32% bonus to somehow mask some deficiencies in expenses, returns, or elsewhere? Yeah, yeah, to some degree, right? So, if we look at Allianz on the IUL side, they have two low volatility indexes, but they really kind of mirror each other on their IUL product. They're almost identical. One happens to be owned by Allianz, and one is, an alternative. And you go into their software, when they were able to show bonuses, it always defaulted to those indexes that showed the bonus. I always ran Allianz, not to get on an Allianz conversation, but I always ran Allianz just in their 1 year point to point. And whatever accumulation solves and designs I wanted to kind of base my foundation on, I ran it without those bonuses. And in instances, they were right there with some others based on their S&P, but again, it's a capped S&P. So is it going to perform as well as an uncapped strategy with another carrier's, indexes? And, I take those bonuses out of the equation just to kind of look at the underlying expenses associated with it. A lot of times, depending on the age, it might be in line with other carriers I'm looking at, Nexus being in that mix, and obviously, and then other times, depending on it might not be in the ballpark at all without those bonuses being shown. You just got to be aware of it. You got to know what you're bringing to your client, because the expectation of that performance is on you, the advisor, and the expectation of that product performance is on me as your wholesaler. So I am surely looking at those things, because I don't want to have that conversation with the advisors I work with. We understand that there's going to be some years in the future where you might have a segment that doesn't perform or not. We kind of hit a little lull towards the, obviously last year with some of these indexes. But majority of the time, in particular with the Nexus indexes, they've sustained solid returns for longer during all these times where others didn't. And all these other underlying factors. The other one thing I would also say, not to get too long-winded, is, yes, this is an accumulation product, but I frankly see this being used as a death benefit product as well, because people do want to see that flexibility of the cash value growth. This nationwide product has a long-term care rider. The Securian product is a chronic illness rider. So we're doing a ton of work in that regard, using those features. I also am using a lot of non-qualified money, just putting in single premiums into these products, and using it as an accumulation vehicle, comparing to a CD or even a non-qualified annuity, because you're getting the death benefit leverage, and we're adding the long-term care or chronic illness rider. And now you got another access point for a client to access that leverage that single premium generated. There's been, especially on some of these segments, I mean, what a segment performing over 2 years at an 86% return, that client is set in their product for a long time. They can get zeros for many years. And that's real. That's a real number. That's a real performance number. And I had many clients, myself included, because I own an Nexus IUL, participated in that. So on the upswing, good markets, these products are going to do better than the market that's out there. And when things are slowed down and maybe a little bit low, we're not going to have as low as lows as other products over time as well. So.
Yeah, good questions. I would add to that, Keith, that on the 49A, it's just a way of leveling the playing field. So it's just basically, you can still use bonuses and products. You just can't illustrate them anymore. And then I would come back, when you're looking at illustration, it's really hard to kind of get I mean, I was in the field for 34 years, so trust me, I've struggled too. So, the illustration is just not the way to look at them, maybe, a way to compare. I get that quite a bit. I suggest a lot of the features that Keith mentioned, great job, Keith, to mention these bonuses or these spreads. You'll see these asset-based charges. There's a lot of different mechanisms that carriers have for cost. You just don't see those in the illustration themselves, but what you see the effect of them is on the annual cost. So we always provide, as we mentioned earlier, that annual cost summary. So that's the place to look, not whether it illustrates this or that. Let me compare, let me run one at 4, let me run yours at 4, let me run yours at 3. Because I would say to you, what are you running if they change the par rate? What do you have if the guarantee changes? So it's going to be more about, like, finding, if you have clients, like Keith mentioned, this becomes a really good strategy for maybe a bank. Maybe you have some assets, cash, things like that. They're not really getting any gain on them. They're just sitting there for your client. That becomes a good piece to peel a little bit off, overfund these things over 3, 4, 5, 6, 7 years, whatever. That's a good strategy. You have a lot of people out there. I have found that many people are very good at building money, accumulating money, but they really don't have a strategy for creating income. So a lot of suggestion in the space about creating income for yourself in retirement, having some base income you can count on, Social Security, your pension. This is another tool to create some income. So, it's always about, for us, it's about just looking at the cost and looking at those par rates and looking at those guarantees. And as a matter of fact, inside that illustration, about halfway through, it's going to show you in there that what the indexes are, whether they're uncapped. It mentions that in the illustration. It also shows the par rates, the current par rates, and it shows the current guarantees. That would be the way I would measure it. We're going to have, we're no doubt about, we're going to have some 0 years. We're not telling you this is a miracle product, but because of the structure and the design, it's going to help you lead to that outcome around taxation for your clients. Maybe a little bit, have the probability is stronger with the design. And you want to, if the client needs the tax deferred growth, they need the income, then this is a product to look at. Now, Keith, you said something near to my heart. I like this as a death benefit product as well, because because a lot of different, the low cost feature, the gain feature, a lot of those things. So yes, I'm in agreement with you on that. So good questions.
I see we have even more questions going, but
Okay.
we're running out of time.
Okay.
So if I may be so bold, I will happily answer all questions or point them in the right direction by email and get back to everybody. But I do want to thank everyone for participating today. This was a great conversation. Thank you, Steve. Thank you, Keith, for
Welcome.
really jumping in and having a great feedback. And I just really enjoyed today's conversation. This was fabulous.
Yeah, well, thank you, everybody. I appreciate it too. It's nice to be a part of you guys, and we love working with you. And, get with Keith. Keith will get with me, or, reach out and we'll see if we can help you. Let's run some cases. Let's help your clients out. Let's help them win, right? It's all about just solving problems for our client, being fiduciaries, trying to do a good job for them, just working hard for our clients, what it's all about. So thank you very much, everybody. I enjoyed it too.
Great.
Have a great
Thank
day.
you. Take care. We'll work with Maureen on getting some answers to some of these additional questions, but I appreciate the
Absolutely.
time and look forward to talking to you. If you want to reach out, we'll provide my contact information and we'll get that going too.
Thanks, everyone.
Bye-bye.